Have you ever felt that sting of panic when markets crash overnight? You open your portfolio, and in a blink, months of profit vanish. Now ask yourself, what if you could grow your money in 2025 and 2026 without risking sleepless nights? So today, I'll reveal the top 10 low-risk investments that will help you earn steady returns and protect your savings from uncertainty. Because right now, the financial world is shifting quietly. The smartest investors aren't chasing hype anymore. They're securing their futures through calm, consistent, low-risk investments. Low risk, the real meaning. Before you invest a single dollar, you need to understand what safe really means, because even the safest option can sink your savings if you misunderstand this. Low risk doesn't mean no risk. It means your money is protected, your returns are predictable, and you can withdraw easily if life throws surprises at you. You may not double your money overnight, but you'll never wake up broke either. Think of it as building a fortress, one brick at a time. Now let's see what goes inside that fortress. Government-backed bonds and treasury bills. Let's start with the safest of all, government securities. These are basically loans you give to your government. In return, you get fixed profits guaranteed by the state. In countries like the US, they're called treasury bills, T-bills, or savings bonds. In Pakistan and other regions, you'll find Pakistan investment bonds, PIBS, or Sukuk for Sharia-compliant investors. Here's why they're gold in 2025 and 2026. Interest rates are still high in many economies, meaning bond yields are attractive right now. And since most are backed by the government itself, the default risk is almost zero. The smart move? Stick with short to medium-term bonds, around 1 to 5 years, to protect yourself from rate fluctuations. National savings schemes and certificates. Next up, national savings schemes. These are government-run investment plans designed especially for beginners and retirees who want safety over thrill. The returns are solid, often in the range of 12 to 15% annually in high-interest environments. Plus, they're tax-friendly in many countries and come with guaranteed payback. The beauty of national savings? You don't need market knowledge or timing skills. You simply invest, relax, and watch your money grow slowly but surely. Fixed deposits and term accounts. Let's face it, banks may not sound exciting, but fixed deposits are a timeless low-risk option. You lock in your funds for a fixed term, stay 6 months, a year, or even longer, and earn a guaranteed interest rate. The pros? Zero volatility, fixed returns, easy to understand. The cons? Well, inflation might bite into your real return, and withdrawing early can bring penalties. But here's the trick in 2025. Lock your FD now while rates are still high. Even if rates fall next year, your locked deposit keeps paying you the same top rate. That's how the wealthy protect their yield. High-yield savings accounts and money market funds. Want to keep your cash close but still make it work for you? Here's where liquidity meets profit. Now, if you want liquidity plus safety, this is your sweet spot. High-yield savings accounts or money market funds give you easy access to cash while paying better interest than regular savings. They're ideal for your emergency fund or short-term goals. The returns won't make you rich, but you'll beat inflation without taking on serious risk. In 2025, digital banks and fintech platforms are competing like never before. They're offering boneless interest rates, no-fee accounts, and instant liquidity, making them a beginner's dream for safe, flexible investing. Corporate and bank Sukuk/bonds, high-grade only. For slightly higher returns, consider investment-grade corporate bonds or bank Sukuk. These are still low risk if you stick with large, reputable institutions. In 2025 to 2026, as interest rates normalize, these instruments are expected to yield 6% to 10% annually, depending on the issuer and tenure. But remember, never chase the highest yield without checking the company's credit rating. If it sounds too good to be true, it probably is. Stick with blue-chip issuers or top-rated financial institutions only. Diversified index funds or conservative ETFs. This is how everyday investors quietly grow rich, not with luck, but with diversification. Now, you might think, wait, aren't ETFs risky? Not if you pick the right ones. Conservative index funds or bond ETFs spread your risk across hundreds of companies or government assets. That means even if one company fails, your portfolio stays strong. In 2025, some of the best performing low volatility ETFs are expected to come from sectors like healthcare, utilities, and infrastructure. industries that stay stable even during recessions. The secret? Don't put all your eggs in one basket. Put one egg in 100 baskets. Dividend-paying blue-chip stocks. Yes, stocks can be risky, but not all of them. Blue-chip companies, the giants with decades of stable performance, are often safe bets for steady, low-risk income. These are companies that make money in any season. Think energy, consumer staples, telecom, or banking. They reward investors through consistent dividends, and their stock prices usually don't swing wildly. The trick? Don't buy blindly. Look for companies with at least 10 years of stable dividend growth and strong cash flow. Reinvest those dividends, and over time, they'll compound quietly while you sleep. Gold and precious metals. When paper burns, gold shines, and 2025 might just be its brightest year yet. Now, here's where things get interesting. Gold isn't just a shiny metal, it's financial insurance. When inflation rises, currencies weaken, or markets tumble, gold shines brighter. It doesn't generate interest, but it preserves value when everything else fails. In 2025 and 2026, analysts expect steady demand for gold due to global uncertainty, trade tensions, and election cycles in multiple countries. Owning 5 to 10% of your portfolio in gold, physical or ETF, is like having an umbrella before it rains. You might not need it every day, but when the storm comes, you'll be glad you had it. Money market mutual funds and digital income funds, the hidden gem. Here's the hidden gem, the one investment quietly beating savings accounts while staying just as safe. And here we are, the #1 low-risk investment for beginners in 2025 and 2026. It's not flashy, but it's powerful. Money market mutual funds and digital income funds. These funds pool your money with others and invest it in short-term, government-backed securities, treasury bills, or top-rated corporate papers. Why is this a hidden gem? Because they combine safety, liquidity, and better returns than ordinary savings accounts. Some digital income funds now even integrate AI-based allocation tools, automatically shifting your money to the best-performing low-risk assets in real time. You get professional management, consistent returns, and instant access to your funds. No wonder more than 60% of new retail investors in Asia and the Middle East are expected to move part of their capital into these funds in 2025. For beginners, this is the perfect blend of earn more, risk less. Now you might be thinking, all these sound good, but how do I combine them? Here's a simple 5-step formula to balance safety and growth. 30% in government bonds or national savings for stability. 25% in fixed deposits for guaranteed income. 20% in money market funds for liquidity. 15% in conservative ETFs or blue chip stocks for mild growth. 10% in gold for protection. That's your safety net for 2025 to 2026. And the best part? You can start small. Even $50 to $100 per month can grow into something meaningful if you start early and stay consistent. Now here's the truth. Wealth isn't built in a single lucky trade. It's built through discipline, patience, and smart positioning. 2025 and 2026 will be years of opportunity, but also uncertainty. And while others gamble on meme stocks or crypto hype, you'll be quietly compounding your money in peace. Because when you protect your downside, your upside takes care of itself. So tell me, which of these low-risk investments do you think gives the best balance of safety and growth? Is it gold, government bonds, or digital income funds? Type your answer in the comments below. I'll be reading every one of them and replying personally to the most interesting responses. And before you go, make sure you subscribe to the channel and hit that bell icon. Because next week, we're revealing the 5 hidden income streams that millionaires use to multiply their cash flow. Trust me, you won't want to miss that one. Stay smart, stay patient, and keep building your financial fortress. See you in the next video.